Hey, good morning, options traders. Well, this video is a special request from one of our very own traders in this group, and he was asking about a previous video, and he said, I think it's where you showed how you could morph into a position that left you with a guaranteed gain, but still allowed you to potentially make more profits. And I've actually showed a lot of different techniques for doing that. That's the very essence of hedging, rolling, and morphing. But I believe he was talking about the box position. And I really don't even remember which video that was from, or I would have just copied the link and posted that to the group. But I've used it and referenced it in many videos. So I thought, well, let's just do a different spin on the box position, a little bit of a review, and show why it creates, in some cases, a guaranteed gain. But then he asked a second question. Does it apply for the sellers? Instead of just buying the call or the put, would it apply if you sold? So they're good questions. Let's go have a look. So let's start with the box position. It's a strategy in and of itself, and it's just the purchase of two vertical spreads. It's really that simple. You're going to buy a bull spread. You're the long bull spread. It's a debit spread. And you're going to buy a bear spread, and you will be using the same strikes. Bull spread, bear spread, both buying, that's a box position. And what it does is it creates a guaranteed position equal to the difference in strikes. So you might think, hey, I love the idea of guaranteed money. Well, hold on a second. If it's guaranteed, you're going to earn the risk-free rate. So a box position is going to behave just like a T-bill. And just like a T-bill, a box position will therefore trade at a discounted price. So with a T-bill, maybe you buy a $1,000 face bill, which means at maturity, you collect $1,000. Well, nobody's going to pay $1,000 to receive $1,000. So they trade at a discounted price. So you might end up paying $990 to collect $1,000, and the difference is your effective profit. Now, when it comes to a box position, same idea. What they're going to do is to mature to the difference in strikes. And because they're guaranteed to mature to this difference in strikes, they will trade at a discounted price. So let's take a look at an options quote board layout. Over on the left, we have calls. On the right, we have puts. On the left of each side, we have the long positions, and on the right, we have the shorts. So let's start by buying the call spread. We're going to use the 100, 105 strikes. You would be long the 100 call and short the 105. Now, this is a debit spread. As I've talked about in pricing principles classes, when it comes to call options, lower strike calls must be worth more money. So if they have the same expiration, we know the 100 strike costs more. So if you're buying the 100 strike, you will be paying more money than what you're collecting for selling the 105. So it's a debit spread. It's a bull spread. We're going to do the same thing over here with the puts. But in order to buy the put spread, we have to buy the higher strike. So we're going to be long the 105 and short the 100. Now it's a little easier to see why it's a guaranteed position if we look at these horizontally. So for those of you who have had synthetics, know that a long call and a short put right here at 100 is a synthetic long position. And I often tell traders, visualize this as a long distance between those two positions. That's a synthetic long stock position. Behaves just like shares of stock. Down below, we have a synthetic short stock position. We're short the call, long the put. So that's going to be just like shorting shares of stock at 105. And again, visually, that's a short distance. So you can see that as a synthetic short. So now, back up, think about it. If you buy stock at 100 and you short stock at 105, you've locked in $5. So that's why it's locking in this $5 difference. So why is it called a box? A lot of times traders say, why is it called a box position? Well, take a look at those four positions, and if you connect them, I'm not kidding, that's why they call it a box position. But it's going to behave just like a T-bill. So the box position is interesting for a number of reasons. It's beneficial to know for strategies and for pricings. We can dig in and get some insights as to whether a particular vertical spread might be cheap or expensive. A lot of reasons that we want to understand a box position. But by itself, it's not really a good strategy. And that's because it's low profit and it's high commission. So in today's world with low interest rates, if you buy a $5 box, you might pay $4.90 for it, or $4.95, and pay far more than that little 5 or 10 cent difference in commissions. It's more of a market maker's strategy who are forced to potentially take a lot of positions, and if they can leg into these box positions, they can certainly be very beneficial. However, for retail traders, they're still good to understand because they're great for legging into over time. They can be very powerful for that. So, for example, let's say that you buy the $100 call for 3, and let's say that the stock is also trading for 100. So it's an at-the-money call. Now the stock has moved up in our favor. It's moved up nicely. Maybe we're coming into an earnings report or maybe a resistance level, and things are starting to look a little dicey. What do most traders do? Let me close it. Let me just get out. And that's usually the wrong idea. You're probably not closing at the high. This is why it's so important to understand how to hedge, roll, and morph the positions. That's what options were designed to do. So let's say that at a later time, maybe you buy the 105 put for $1. Now keep in mind, when you first bought that $100 call, you would not have been able to buy the 105 put for $1. Why? With the stock at 100, the $5 put had to trade for at least $5, plus some extrinsic value. But because the stock has moved in our favor and time has gone by, the price of this put has slowly whittled away down to $1. So it has now presented a nice opportunity for us. If you pay 3 and then you pay 1, you've paid a total of 4. And this is where most new traders say, oh, therefore, the most you could lose is 4. You're increasing your risk. Not true. You have legged into a box position. Take a look. You have the right to buy shares for 100, and you also have the right to sell them for 105. That's a guaranteed $5. Now you might say, but wait a minute, we didn't use a vertical spread. That's okay if you understand vertical spreads. They're just ways of hedging the calls and puts. We don't need to use them. The key is here that we bought a put with a strike higher than our call. That's what's allowed us to box in the 5 points. So if we've paid a total of 4 and we have a guaranteed $5 coming back, that is a guaranteed $1 profit. But notice we didn't let go of the position. We own the 100 call, we own the 105 put, we own the 100, 105 strangle, but for a guaranteed $1. So this is what our risk graph looks like. So here are the strikes right here at the bends. There's your long 100 call, there's your long 105 put, and you can see that this flattened portion, the lowest that it sits is right here at $1. That's your guaranteed $1. But we still own the call and the put. So we still have the ability to make unlimited gains up or down. Now again, this doesn't mean it was a perfect tool or a perfect decision, because had we just sold the call, yeah, maybe we could have collected 2 or 3. So we are creating trade-offs, and that's why it's so important to understand what's happening here. But for many situations, this is a beautiful way to, in this case, morph the position from a long call to a long strangle. So the box positions, just remember, it's one of many ways to create hedge positions or morphed positions just like this. But they still keep you in the position. That's the key. So now part 2 of his question was, can it work for sales? Very good question, and the answer is always yes. Remember that when you place a trade, there's a buyer and a seller. It's just 2 different ways of looking at the same trade. It's no different than betting on an upcoming football game. If I take Team A and you take Team B, we're betting on the same game. Everything is the same. It's just a question of maybe which side of the field we're sitting on. And that's the same way you want to understand trades. Anything that can work for a long position can work for a short, because we're just looking at the same trade from a different perspective. So for example, let's try one with a vertical spread, where we actually leg into a vertical spread. Let's say that our stock is 100 and you buy the 105 call for $1. It's out of the money, and now the stock has moved in your favor, but we're now turning bearish. And we now look at the quotes and we see that we can sell the $100 call for 7. So if for some reason you've now turned bearish, let's say that you sell this 100 call for 7, and notice that you have on a net basis received a net credit of 6. You bought for 1, you sold for 7. Now because this is a credit spread, notice you are selling the more valuable strike, the $100 call. And that means you might owe the difference in strikes. Remember, I told you it's just like betting on a football game. The person who buys the 100-105 vertical spread is betting for the stock to go up. The person who sells it is betting for it to go down. It's a bear spread. So you've received a credit of 6, but you might owe the $5 difference in strikes. Well, that's fine. If somebody hands you $6 and says, give me $5 back, you should be willing to do that all day long. You can't lose. You've got a guaranteed buck coming in, but you still have the short vertical spread. So this is what your strategy would look like right now, your risk graph. Right here's your short $100 call. This bend is your long 105. It's a bear spread. It's a credit spread, but notice that the very lowest portion this graph sits is here at +1. So there's your guaranteed dollar. But if the stock price falls to 100 or below, both of these calls expire worthless, and you can now keep the full 6. So again, it's another wonderful way to use, in this case, a variation of a box position, but just from the short side, where you can get yourself into a guaranteed position, but still potentially hold out for more. It's really the very essence of options trading. So if you're not really getting the most from your options trading, or your profits aren't what you think they should be, my guess is that it's because you're not understanding how to hedge, roll, and morph your positions. And the box position is one of the most powerful to understand. And for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a brand new technical analysis course. It's all at optionsatoz.com. Also, please join us on the Facebook trading group, Options A to Z, and you can find a link in the description below.